This week could end up being one of the most volatile for the markets. All eyes are on the Fed's October 29th meeting, where a rate cut is expected. Now, to be clear, a 25 basis point cut is already priced into the markets. The CME FedWatch tool puts the odds at over 98%, bringing the federal funds rate down to 4%. The cut itself is not the headline. What really matters now is the pace of future cuts, the tone of Powell's commentary, and how the Fed frames its economic outlook. The big debate is whether we're looking at a slow, cautious path or the beginning of an aggressive easing cycle, and either direction could dramatically shift market sentiment. And at the center of it all is inflation and unemployment. These two forces will dictate everything from here. So, what can investors actually expect? And more importantly, how will each sector of the market react? I'll walk you through the 3 potential Fed scenarios, how to interpret them, and most importantly, which sectors are best positioned to potentially thrive in this new environment. We'll break down large cap growth, small caps, dividend ETFs, and fixed income, and why each one reacts differently when the Fed pivots. Starting with small caps. Small cap stocks and ETFs are incredibly sensitive to interest rate expectations. Why? Because they rely more heavily on borrowing to fund growth. So when rates drop, borrowing becomes cheaper, and that can fuel expansion, revenue growth, and ultimately stronger valuations. Now, just for reference, after the Fed's second rate cut during the last cycle, small caps outperformed the S&P 500 by more than 2x. Another reason is that many small caps carry variable rate debt, which means that a rate cut hits immediately, whereas large caps tend to hold fixed rate debt, which delays the impact. But small caps are a double-edged sword. They're highly volatile and extremely sensitive to economic sentiment. So what happens in each Fed scenario? Scenario 1, the Fed cuts 25 basis points, but signals a cautious path ahead with fewer cuts, citing inflation as a primary concern. In this case, small caps could get hit hard. Even though a slow pace implies confidence in the economy, fewer rate cuts mean treasury yields stay elevated, and that keeps borrowing costs high for small caps, which is not attractive to investors, which means large caps likely benefit the most in this scenario. Scenario 2, a 25 basis point cut with gradual easing ahead. This is the Goldilocks setup. Inflation is cooling, the labor market is softening, but not alarmingly. Small caps could surge as rate-sensitive sectors come back into favor. And scenario 3, the Fed cuts rates by 25 basis points and signals aggressive easing due to labor market deterioration. If the tone signals fear of a recession, small caps could get crushed. And it's not just small caps, even large caps could experience a significant sell-off. So the takeaway is that small caps are the most interest rate sensitive play here, but also the most exposed to fear. And that is why quality matters. Now, most ETF investors are familiar with the usual small cap names like IWM, but there are also platforms like Investing.com that use AI-powered tools to curate targeted portfolios, including small cap portfolios built around strong fundamentals. And when you look at the track record of this AI-generated small cap portfolio, the results have been very strong. It's outperformed the Russell 1000 since inception. Now, of course, past performance doesn't guarantee future results, but tools like these can help investors explore data-driven insights and identify potentially higher quality opportunities. And this brings me to today's video sponsor, Investing.com. Most of you already know the platform, but I want to focus on their flagship product, Investing Pro. Investing Pro gives you access to a massive database of global stocks and ETFs, each one backed by advanced financial metrics, in-depth research tools, portfolio construction features, and both technical and fundamental analysis. It even integrates AI-driven investment ideas to help streamline research and idea generation. Now, one of my favorite features is their ProPicks AI, which, as mentioned earlier, builds model portfolios based on different strategies, like tech titans, Warren Buffett's top 15, small cap sprinters, or the S&P 500 value portfolio, etc. Inside, you can see their historical performance, rebalance details, and overall risk profiles. Each portfolio includes detailed breakdowns of every stock inside with key data on financial health, earnings, cash flow, valuation, time of purchase, and time of sale. I use Investing Pro very regularly, and in my opinion, it helps investors cut through the noise and simplify their research process. Of course, as always, past performance is not indicative of future results, and this is not financial advice. I am simply sharing one of the tools I use to enhance my own research process. Another feature that I really like to use is their Warren AI. You can think of this as their version of ChatGPT, but with access to a massive built-in financial database. So when you ask a question, the The responses are backed by real data and analytics rather than surface level summaries. There's a lot to explore, and if you want to check out Investing Pro for yourself, you can use my link down below for 15% off, which is also stackable with any platform sale they have active, such as the upcoming Black Friday sale, which means that you can get up to 55% off using my link or code Victoria Media. Now, moving on to fixed income ETFs. As most investors know, interest rates and bond prices move in opposite directions. So when yields fall, bond prices typically rise, and that is exactly why the sector is getting renewed attention heading into the next rate cut. But not all bonds react the same way. It depends on duration. The longer the bond's duration, the more sensitive it is to changes in interest rates. That is why long-duration bond ETFs like TLT have been seeing major inflows, hoping to capitalize on price appreciation as yields fall. The longer the duration, the bigger the potential move. But of course, there are alternatives for those who want exposure without as much volatility. These would be shorter duration bond ETFs like IEF, AGG, or even high-income ETFs like TLTW, which writes covered calls on TLT and provides income while reducing volatility. Now, let's break down the three scenarios once again. Scenario 1, a 25 basis point cut with cautious tone and fewer cuts ahead. This could actually put downward pressure on the bond market, especially long duration ETFs like TLT. Why? Because fewer cuts ahead means 10-year yields could bounce higher again, hurting bond prices. Short duration bond ETFs would likely hold steady or see only minor downside. Scenario 2, a 25 basis point cut with gradual consistent easing. This is again the Goldilocks scenario. In this scenario, long duration bonds would likely rally as the market gets clarity on a steady path for lower rates, and TLT would benefit the most here. And scenario 3, which is rapid rate cuts due to a deteriorating labor market. And ironically, this would also be bullish for bonds, not because the economy is doing well, but because bonds become a flight to safety hedge. That is a very important point. Investors will pile into treasuries as a defensive move, and this is where bond ETFs and small caps diverge. Small caps might sell off on recession fears, but bond ETFs rally. So while bonds don't rely on earnings like stocks do, they are deeply connected to Fed policy and inflation expectations. So if the Fed disappoints or inflation flares back up, that is bad news for the bond market, especially long duration bonds. Lastly, let's talk about dividend ETFs, and this sector is a bit more nuanced. In general, rate cuts are positive for dividend paying ETFs. That's because when yields on treasuries and saving accounts start dropping, investors begin seeking alternative sources of income, and dividend ETFs suddenly look much more attractive. However, there's a catch, and that catch is the financial sector, which tends to make up a core portion of many dividend-focused funds. Here's why it's a catch. Banks thrive when interest rates are high. They borrow at low rates and lend at higher rates, capturing the spread, called the net interest margin. But when the Fed rapidly cuts rates, that margin shrinks, and that directly impacts earnings and profitability for financials. So let's walk through the three scenarios. Scenario 1, a 25 basis point cut with cautious tone and fewer cuts ahead. This would be neutral to slightly positive for dividend ETFs. Investors may start rotating into yield-generating assets, but financial-heavy dividend ETFs won't see much pressure. However, ETFs with more large-cap tech exposure, like FDVV or DGRO, could benefit more here since large-cap growth would likely lead. Scenario 2, the Goldilocks outcome, a 25 basis point cut with signals of gradual easing. This is where dividend ETFs will benefit. Yields on treasuries become less competitive, and with no panic about recession, investors rotate into high-quality dividend names for consistent income. And while the financial sector could see a modest lift from improved sentiment and credit demand, the impact depends on whether the yield curve steepens enough to support bank margins. And scenario 3, a 25 basis point cut with a signal of rapid cuts due to a weakening labor market. Here, dividend ETFs might struggle, especially those heavily weighted in financials. But in my view, they could still hold up better than growth-oriented assets simply because they're often seen as defensive plays in uncertain environments. Remember, dividend ETFs are considered risk-averse long-term holdings, and financials only make up a portion of the ETFs. They tend to have allocations towards sectors like consumer defensives and utilities, which are risk-averse sectors. And in times of volatility, investors seek them out to stabilize their portfolios and maintain cash flow. So while not every dividend ETF will respond the same way, the sector allocation is everything. So overall, we have now broken down the 4 key sectors of the market. Now, as I mentioned earlier, investors need to closely watch what the Federal Reserve and Jerome Powell specifically says about inflation, the labor market, and of course, it's important to pay attention to the tone of the meeting as well. The dot plot will also be crucial as it maps out the Fed's projected pace of future rate cuts, and that will heavily influence how the market responds. Now, before we wrap up, I wanted to quickly remind you guys that Black Friday is just around the corner, which means that Investing Pro is going to have a big sale, and you can use my affiliate link or code Victoria Media to get an extra 15% off on top of their platform sale. So take advantage of it and stay tuned to my channel to keep up with all their offers. And that is all for this one. If you haven't yet, make sure you subscribe to my channel and hit that thumbs up button for the YouTube algorithm. Thank you guys so much for watching, and I will see you in my next one. Bye! This video is for educational and entertainment purposes only and is not financial, investment, tax, or legal advice. Discussions of ETFs, investing strategies, market updates, or specific funds are general, not tailored to your financial situation, and should not be relied upon for decision-making. Investing involves significant risks, including total loss of principal, and past performance does not guarantee future results. I am not a registered financial advisor. My content reflects personal research and publicly available information. I may earn affiliate commissions from mentioned products or links disclosed per FTC guidelines, but these do not influence my opinions. Always consult a licensed financial professional and verify information independently. By watching this, you agree I am not liable for any losses or consequences from your actions. International viewers should consult local regulations.